Welcome back for this week's episode of the YVR REMO Show. I'm Dean Lawton, and I can't wait to share with you what we have in store for today's episode. But before I do, I just want to remind you, please subscribe to wherever you're listening to this or watching this on YouTube. And if you like it, please give us a like. That means the world to us. And especially your comments. Engage with us. Let us know what you're liking, what you're not. And whatever we can go deeper on, we're all ears. For this week's episode, we're going to get into the cost comparison of A lending, alternative lending, or otherwise known as B lending, and private lending. And as we go through each of those lending demographics, we're going to touch on some of the new clients that we're seeing fall in each of these buckets. And I think this is going to be a real impactful episode for anyone that's wondering, how can I move forward if they're stuck, especially clients that are stuck at their bank. So we have a lot in store for you, and I can't wait to share with you. So please have a listen.
What's up, guys? You are listening to the YVR REMO Show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated.
So there's a lot of confusion in our industry in the different buckets of lending that are available, typically referred to as A, B, and C. So we wanted to dig into these in detail. We'll start off with A lending. We've actually done a 3-year cost comparison of what the finance cost will run you for these different types of financing. Keep in mind, this is all subjective, depending on your situation and credit ratings and income and down payment amounts. But we'll start off with A lending. Dean, if you want to run through that.
It'll be important to understand who gets placed into these buckets, especially in today's current market. That is different. We're seeing a lot of a different, I guess you could say, avatar of a client going towards an alternative lender than we might be, historically familiar with. We'll jump into some of the costs, and then we'll touch on just who those people are that we're seeing fall into these buckets. So in today's market, this is an average rate range. We are seeing rates lower on certain terms right now, but in general, with the big 5 banks and all the credit unions that you would be familiar with, we're seeing an average rate range of somewhere around 5.79%. Again, depending on the term, and that's a fixed term, and so depending on how many years are in that term. We can touch on variable in a later date, but those are obviously a little bit higher now, and that's probably a whole nother topic that we can get into. So if we're going to go with a 5.79 rate range, we're going to look at numbers on a $500,000 mortgage. That's about the average mortgage size that we see in our office. And looking at that over a 30-year amortization, the total cost on the monthly approach would be $2,908 per month for a $500,000 mortgage at 5.79%. And we wanted to try to summarize this in a 3-year total cost approach. Reason being is the average Canadian has a mortgage for about 3.2 years. So let's look at this as a 3-year total cost. So the total cost of this mortgage at this interest rate would be $84,155 in the total 3-year outlook that I provided here. So we'll note that, and then we'll compare that to the B approach or alternative lending approach when we get there. But maybe we could just touch on some of the people that we see now falling in the A lending bucket.
Yeah, and again, the goal here is to unpack these different buckets of lending and what they mean and what the lenders are offering and why people would end up there. And by no means are we trying to suggest that, falling in place with an alternative or B lender is going to be better than A. If you qualify with an A or conventional lender, that is always going to be your best option. Maybe not for flexibility, but it's always going to be the lowest cost. There are no fees. You're typically always going to see the lowest possible rates. To qualify with these lenders, as we all know, if you've been through a mortgage in the last 3 to 5 years, it's very, very challenging to secure lending from these lenders. They're very, very picky. So your credit needs to be absolutely perfect. And if it isn't perfect, we need to have a very good story as to what happened at that point and what caused the potential hurdle. And that's where planning really comes in handy in these situations. Having a detailed discussion on, what caused the missed payments and why, and building that story before you're presenting your application to a lender, that's really going to go a long way. But for the most part, they're looking for perfect credit. Anyone that's heard of an insured mortgage, so that's typically a less than 20% down purchase mortgage. The only option for that type of financing is through an A lender. So these are your banks, your credit unions, and mortgage finance companies. So again, insured mortgages, your only options are through A lenders. You're never going to have a B lender playing in that space. The last big piece, I mean, there's obviously a lot of regulation that comes around this, and qualification is always going to be the most challenging with A lenders, but the income side of it, this can be a huge piece. So, maybe someone that's been a commissioned sales role for less than 2 years, or, maybe it's someone that has started their business 6 months ago. These are always going to be situations that are typically not going to fall in place with an A lender, and you're pushed over to the next bucket. A lenders are looking for, someone that's been full-time employed with consistent pay stubs. This is something that people don't think a lot of. If your pay stubs are not showing 40 hours a week, oftentimes conventional lenders actually won't accept your income unless you've been there for 2 years, because your income fluctuates too much. If you're self-employed, they're going to be looking for 2 full years of tax returns, not just running your business for 2 years, it's actually having 2 full years of tax returns, and they're qualifying you based on your net income. So just to kind of recap, conventional or A lending is your best bet if you qualify, but it is going to be the most challenging bucket to fall into place with.
Yeah, so just to kind of wrap that up, it's very challenging in a lot of these cases, just based on what you said. It's a tough bucket to get approved in, especially if you're self-employed. It can be very challenging just based on those points that you made. And also, one of the biggest challenges we're seeing is the stress test. There's been no change or any revision to the stress test from the government perspective. So that's a big challenge to get even just your normal employed client approved in this bucket, because of the fact that the stress test rate is so much higher based on the rates being higher today. So again, no change to the stress test other than just the natural change of the rates have gone up. So it's harder to qualify for as much as we could in the past. And that's a good segue into the B lending bucket is that's where we'll start to see some flexibility. And that's where we start to see, some of the numbers work in your favor, and it makes sense to look at B lending. And we call it B lending, but I would say more commonly known as alternative lending nowadays. So what is an alternative lender? What does their cost look like? And I can touch on some of that right now. So moving over to the alternative lending side, or B lending side, looking at the same mortgage amount, $500,000, rate 6.3% on average. That's kind of what we're seeing right now, 6.3%. So going from a 5.79 to a 6.3, yeah, of course, a higher rate, but for a lot of people, that it actually surprises them that it's not more than that. And I'll touch on where the higher cost comes into play, and that's going to be on the fee. So this is where a fee is introduced. Could be a new concept or a surprising concept for a lot of people. We're typically seeing anywhere from 1 to 1.5% fees for alternative lending products. So let's use a high end. It should never be more than 1.5%. And on a $500,000 mortgage, that means $7,500 is being added to the loan in the case of a refinance. Or if you're purchasing, you have to essentially come up with an additional $7,500 to make this deal work. So that's where you're going to see a big increased cost, and again, might help you understand why the rate is not that much more. So that's the increased cost is in a whole is 6.3% rate and a $7,500 fee. This is where it could be quite beneficial to consider alternative lending is what the payment looks like. So the payment from 6.3% is going to be $3,068 a month, $2,908 in the A comparison that we were looking at. So, on average, $170 increase a month. Again, not a huge increase per month, something that you would totally look to do if it meant actually getting you approved versus not getting you approved. That could be, a real easy decision. But again, where is the $7,500 come into play? The most important thing to note is it's only a one-time fee. So if we're looking at this as a total 3-year comparison, like we did in the A lending approach, total cost is going to be $99,129 in 3 years versus what we noted in the A side was $84,155. So roughly, we're looking at roughly an additional $3,500 a year. If we're looking at this as a 3-year approach, about $3,500 a year in additional costs. So if that means getting approved versus not getting approved to buy a home that, we know is going to, we're buying in arguably a very, very much a bottom of the market scenario, or getting close to being at the bottom of the market, that could be a no-brainer to some serious appreciation down the road. So that's definitely a plus to consider. And looking at this as a total cost approach is the idea here, is that this isn't a bad thing. Like, the myth behind alternative lending is it's a bad product. It's expensive, but knowing the true cost and looking at it as a whole approach versus the benefits and the opportunities is really what we're trying to hone in on here. And I think when you look at it that way, there is a lot of positive in going this way versus just not doing anything, not acting.
Yeah, a couple of things from a listener's perspective. You're probably going like, why the hell would I take a product like this? But again, digging into what Dean referenced about, like, why would I not be getting a mortgage from an A lender? Well, back to the issues that we talked about, like maybe your income isn't presented as it should be. Maybe your credit isn't perfect. Like maybe you're not qualifying because of the stress test. So this is where these alternative lenders, and I think the whole industry is trying to work away from B lending because it doesn't sound very promising. But these are, just to touch on the lenders, one of the questions I get all the time is like, who's a B lender? Like, are these private lenders, or is this like some guy in his garage that's lending money? Like, these are institutional banks, right? They're actual banks. A lot of them actually have branches and they have online portals, just as a lot of mortgage finance companies do. And the mortgage itself is a very, very, very similar product to what you would get from a traditional A lender, right? Like there aren't a lot of differences. Some of the penalty calculations can be a little bit different, but at the end of the day, the big piece that's a difference is the cost. So if you can justify the cost and it's allowing you to move forward with your purchase, these programs are amazing, especially in this market. And some of the reasons for that, we saw quite a few alternative lenders come to the table before A lenders offering 40-year amortization, right? A lot of the A lenders that you're hearing about offering a 40-year amortization are only doing that in situations where people actually need assistance. The alternative lenders have come to the table saying, like, we'll offer this on a purchase if you qualify for it. Again, like, these lenders are allowing you to push forward if your credit isn't perfect. And it doesn't have to be just not perfect. We've done alternative mortgages for people with 450 credit scores, right? If it's a life situation and we can justify the reasoning, and I'm talking like a divorce, right? Like, these are situations that can absolutely destroy someone's financial situation and they're trying to get back into it. So if the story makes sense, these lenders are a little bit more lenient. They have a lot more flexibility. The income piece, right? We talked about self-employed. The amount of self-employed borrowers that we have helped into a property that they've been declined for on the A side, I can't even count. Like, there's hundreds, if not thousands of people, and they've benefited dramatically from getting into that property, even though the cost was a little bit higher. One consideration, just so that everyone knows, and I touched on this in the A lending section, you have to have a minimum of 20% down to achieve an alternative mortgage. You cannot get an insured mortgage through an alternative or B type lender just because of the exceptions that they're typically making. Now, like, the cost comparison, we're talking $3,500 a year, maybe $12,000, $13,000, $14,000 over 3 years, where if this allowed you to get into the market now, into a property that you otherwise weren't going to be able to purchase, it's not unreasonable to think that a townhome in Langley is going to appreciate by $150,000 in 3 years, right? So you kind of have to look at it like a cost of doing business, opportunity cost if you don't take that approach. And this last piece, we talk about a fee of $7,500 on a $500,000 mortgage being the top end on the fee. But if we circle back to A lending and insured mortgage, the highest in CMHC premium that you can pay is 4%. So, like, we're talking about a 1.5% fee for a B lender or alternative lender to get you into a home. Whereas that person who maybe has perfect credit and they have strong income and they're buying with 5% down, they're actually paying 4% in a CMHC premium to purchase that home. But that cost isn't really frowned upon just because it's an A-type mortgage, right?
Yeah.
So there's a ton of benefit in this alternative space right now, and a lot of our clients are taking advantage of that.
Like, to wrap all that up, a new trend that I'm seeing, and like everything you mentioned of why would somebody land here, is typically qualification issues or challenges at the bank, which are all going to come back to a qualification issue. We're seeing a lot of clients go in this direction for an actual cheaper cost per month with the 40-year amortizations, with these extended amortizations. If they can buy a home with that from the onset, it will potentially make their home cash flow. If this is a rental property, they could look at an increased cash flow situation. So, like, in this same alternative lending scenario that we went through, if we had a 40-year amortization, it brings the payment down to closer to $2,800 a month, which is actually a cheaper amount per month than the A lending approach. So from a cash flow perspective, this could make a lot more sense. And then that, so we are seeing clients go in this direction just to have potentially a better cash flow situation. But then that also is going to equate to a higher qualification too. So that back to the qualification side of things, lower payment, qualifying on what we would consider higher ratios, which is, another topic in its own right when it comes to debt service ratios and whatnot. But we're seeing people actually save money per month out of pocket with one of these lending options.
Another consideration is, so these markets, they always change, right? Like right now we're looking at alternative mortgage rates that are about 0.5% higher. Some lenders, if you compare them, they're actually very, very close, but we'd want it to be conservative here. It's not always like this, right? So if you jump into a 3-year mortgage with an alternative lender, you could be up for renewal in 2026, and the alternative rates could be a lot higher than what's being offered through the conventional A lenders. The reason I bring that up is if you can get out of an alternative mortgage over time, like a credit issue as an example, if your credit's not perfect right now, we can set you up on a credit repair program so that when you are up for renewal in 1, 2, 3, 4 years, you can transition back to the A lenders. I think you should always have a goal of getting back to a conventional lender, because we have seen times where alternative rates are 1.5% higher than the banks. Yeah. So that will fluctuate. This is a little bit unique, and that's why a lot of people are taking advantage of it, because the rates aren't much different, and the fee, a lot of people can justify paying it to make a purchase or a refinance happen.
Yeah, these are historical times. Like the gap from interest rate and total cost is as close as it's ever been. So these products make a lot of sense now. Where we are in, say fast forward 2 years from now, rates should have come down by that point. So of course it would make more sense to look at an A option. Moving away from this, the last bucket of opportunity that we see is private lending. This is, going to be your typical feared lender, like the guy with the briefcase of cash. Like that's not the case as well, but that is definitely the myth and perception of a private lender is going to be somebody that you definitely don't want to be with. And you can argue in a lot of cases that this probably isn't an option for a lot of people. It's totally scenario dependent. We'll get into like why it makes sense, but just from a cost perspective, costs are a lot higher in this bucket, just like the other two buckets right now, given the market we're in. So again, looking at a $500,000 mortgage as a comparison, there is a fee, just like an alternative lender. We have fees. They're going to be higher in this case than we would see on an alternative lender. So typically 2% fee is kind of the minimum that we see on the alternative lender side. So for a $500,000 mortgage, that's now $10,000. The average rate we're seeing on first position mortgages right now is 8.99%. That's also quite high from where we were. I mean, if we go back to the good old days of February of 2022, that could have been as low as 5.49%, depending. So again, 8.99%, that's up from 6.3% in the alternative situation. Amortizations here, it's always going to be interest only. Well, not always, but I would say 9 times out of 10, the lender is going to offer you an interest only payment. So helps with the total payment amount. Total payment out of pocket here would be about $3,745.84. So a little bit, we're looking at that as a comparison again to the alternative scenario. It's about $700 more per month. So that's a big jump. But again, I think it really depends on why we're going here. Why we're going here could not only make a lot of sense as to, hey, there is no other options, but looking at the total cost, I think a big reason why we're going here, I'll let you kind of take it over from here, but is debt consolidation and what does the total debt scenario look like from a monthly cost perspective? And that's where you could justify potentially looking at one of these options to bring down the total cost of borrowing as a whole.
We've done, again, probably thousands of private mortgages while we've been in this industry, and every single time, like there's a reason for it, right? No one is taking this mortgage if they don't need it, or it doesn't make sense, or there isn't an exit strategy. Like we talked about, the alternative lending piece and getting back to an A lender. If someone's taking a private mortgage, especially, I know I can comment on this if you're working with us, you're taking that mortgage with an understanding of what you need to do to get out of it. Because nobody in this world wants to be sitting in a 9% mortgage forever. It doesn't make sense financially, right? Well, for some people, they can justify it, but there's always a make sense situation. So a couple examples. We've had people call us and say, hey, I've racked up a lot of debt. That's very common right now. We just went through Christmas. People are facing layoffs, gas and food and everything else in life is expensive. Maybe your mortgage payments have gone up. So when that happens, you start to use credit cards and lines of credit. And, there are some people, a lot of people that are getting into a little bit of, trouble financially. And the fallback, luckily we have this fallback where we live. A lot of people have a lot of equity in their homes, right? So, one example, people came to us and said, hey, you know what, we got about $100,000 in debt. We need to consolidate. We want to refinance. We want to redo our whole mortgage. So we look at that and see that they have a 1.9% fixed rate mortgage with 4 years remaining. That would be an awful move and awful advice if we redid that whole mortgage into a 5.79% product with a bank, right? Even though it's an A lender, it wouldn't make sense because they're losing that 1.9% on a big chunk of money that they had mortgaged. So instead, you do a second mortgage through a private lender at 9-10%, and that blended average is going to work out. If you take, $600,000 at 1.9 and $100,000 at 9%, that blended average is going to work out to something very reasonable, probably in the 3.5, right? They get to continue to maintain their really cheap mortgage for 4 years. And the goal is once they're up for renewal, we're going to refinance and consolidate everything into one conventional mortgage. So that's really, really common right now. A few other, scenarios that we've seen is, again, there's opportunity in this market. It's a scary market for sure. There's a lot of skepticism, which I think is fair, but there's a lot of investors that see the value because properties have come down a lot. And some of these people might be leveraged. Maybe they don't qualify for the mortgage, but they have equity or they have cash. And if a bank tells them no and an alternative lender tells them no, this is your last stop. And some people can still justify buying a property, maybe renovating, building up that equity and then selling it. So that's a scenario that's very case by case. I think you need to be a pretty savvy investor to do something like that in a market like this. But these are situations when every other option says no. If you can figure out this cost and work it into your business plan and there's still profit, it's a cost of doing business.
Right? Yeah. So just to kind of end it there, one of the the very interesting things, or something I find very interesting, is that the different types of clients that are falling in these buckets and private lending. I mean, this was kind of based on, an acquisition type of approach or the same loan amount. But, one of the biggest reasons we're seeing people land with a private lender is just to get that second mortgage, preserve what they have in first position with their, their great low rate of 1.89 fixed, or anything in the low 2s or 3s, even for that matter, even the 4% range. These are rates that we're now considering absolutely fantastic rates that we would not want to break for any reason. And so to take, $100,000, $200,000 in a second mortgage product makes a lot of sense to ultimately just, again, preserve that what they have already and pay down much, much higher interest debt. So again, I think that's one of the most interesting parts of all of this is just the avatars and the different types of people that are falling in these buckets, and now needing the education on who these lenders are, why are they getting with these lenders, and again, just having like the actual education to why this is the right lending product for you, and not just being, having it jammed down your throat, like actually telling you why this makes sense and showing you the numbers like we're trying to outline here today is the most important, because at the end of the day, the numbers don't lie. And that's really, that's really the guts of it all.
From my side, I scream this till I'm blue in the face, but going through this process to understand what your options are, there is no harm. It's maybe going to take you as the client an hour to do an application and submit some documents. It's going to take us a couple of days to work through it and present it to you. And you just have to go through that to understand your numbers and look at your payments and do some budgeting, right? And like, there's just a lot of fear around, like, what if I don't qualify? My credit was, shit when I was 19. Is this going to impact me now? And so many people don't reach out because they're worried about that. And they'll go to their bank instead, and the bank's going to say no, and they won't present that next alternative option. They don't know the private lending companies, right? So anyways, just as a parting word, reach out to us. There's absolutely no harm in going through this process. The worst thing that's going to happen is you're not going to qualify, but we can show you what you need to do to get there.
Yeah, and we'll just end it there. I mean, it's we appreciate you listening, and if you obviously if you're enjoying this or you're listening for the first time, make sure to subscribe. All the buttons are down below on wherever you're listening to this or watching this, and yeah, definitely shoot us a comment if you're enjoying this content and you want more, and whatever you do want to hear more about, we're all ears. We'd love to hear from you, and thanks for listening.